Well, good evening, ladies and gentlemen. I am very pleased to welcome you to the Bank of Italy Donato Menichella Center. This is one of our premises in which there are important functions of the bank that are performed in these buildings. And also this is this beautiful auditorium in which we can have meeting, conference, and seminars. I also welcome you on behalf of the board. And the Bank of Italy has a special relationship with research. And and it is not incidental that we host conferences. We have a program of seminars, and our economists try to do their best to be in the academic debates and to produce research. But we also rely on the research of the academic to get advice in these challenging times, especially for financial economists, financial research in the financial subjects, because the financial landscape is undergoing rapid change, and one of the previous governor, the first governor of the post-World War II, that was an economist too, an expert in public finance, Luigi Einaudi, was usually saying, this is a motto, and this motto is "conoscere per deliberare," that it may be translated, we must know before we decide. This is more or less what. And this kind of culture of analyzing and taking stock of the better research that is around is still part of our daily conduct of the Bank of Italy. I would also thank the staff here of the Center of Donato Menichella that has done a great job to making possible this event and make possible to have this conference held here in this stage. This is the premises of the Bank of Italy, so we have strict security rules. So I would kindly request not to take pictures outside of this conference room, outside, and also ask gently to drop your badge at the end of the conference. Outside there will be a box in which you can drop your badge. Having said that, I just stop here, and I have a second task to accomplish, that is to introduce Professor Garry Gorton, that will give the keynote speech of this EFMA conference. Professor Garry Gorton does really not need any introduction. His research is well known. He has his analysis of he is studying crisis for almost more than 20 years, I think. And his contributions has been a great impact, and his research has changed our views on the crisis, on what are the causes of crisis, and what is the right policies to address crisis. Tonight he will present a piece of his recent research in this area, and I'll just leave the floor to him. And thank you very much for being here.
Thank the organizers for inviting me. I'm happy to be here to talk about the financial crisis. I think maybe people are getting a little tired of hearing about the financial crisis by now, but I would urge you not to have this view. The financial crisis was not only a problem in terms of the human toll of a financial crisis, but it was a problem for economists and economics more generally, because it was a massive embarrassment. Economics had no policy advice to give. Economists hadn't studied financial crises. And outside economics, I think the view of the profession has plummeted. And it's up to us to try to make sense of the crisis so that next time we have sort of a more intelligent response. So I'm going to talk about the crisis, and I'm going to show you a bunch of pictures. It's an empirical paper that's joint with my colleagues, Metrick and Shea. Leigh Shea was one of our students. And I'm going to try to change perhaps your view of the crisis. So let me just start by saying that there's a lot to explain. The subprime, saying subprime doesn't explain the crisis. First of all, it wasn't very big. So the realized losses, and this is from trustee reports from securitizations, the realized losses on almost $2 trillion of AAA subprime outstanding as of August 2013 was 24 basis points. And in a typical securitization, about 85% of the securitization is AAA. So this, on a AAA bond, a 24 basis point loss is an order of magnitude higher than losses on corporate bonds that were AAA. But it's still not the case that this by itself can really explain the insolvency of the U.S. banking system. So a systemic event means it's systemic. The whole financial system is insolvent. So a crisis is not just some bad thing. It's not a stock market crash. It's not the S&L crisis. It's when the entire banking system is insolvent. And Ben Bernanke, in his testimony to the Financial Crisis Inquiry Commission, said that of the 13 largest financial institutions, 12 were on the verge of bankruptcy in the United States in the period just after Lehman. So there's something to explain. There's something to explain. Now, the narrative of the crisis, the popular narrative of the crisis, which is that greedy, evil bankers concocted toxic assets to sell to unsuspecting investors based on fraudulent ratings, is not a very compelling story. For one thing, it's interesting, and the most important question is, why didn't the United States have a financial crisis before 2007? There was no systemic event between 1934 and 2007. And the most interesting question is, why did that happen? That was an extraordinary period in U.S. history. Most of U.S. history has a systemic event every 10 years. Certainly the entire 19th century is like that. So there's a lot to explain. So I'm going to start by trying to convince you that the standard view, this is one of the standard views of the crisis, is not very convincing. So the standard view, and this is among economists and outside economics, is that there were two shocks. There was this subprime shock, which wasn't very big, and if that was all that happened, then we would have had a mild recession and we wouldn't have had a systemic event. So the famous economists have said this publicly. So their view is that the problem was that there was a second shock, and the second shock was Lehman Brothers. So the view is, if there was two shocks, and if it had not been for Lehman, there wouldn't have been a problem. That's the view I think is completely wrong. And just to give you a sense of why it's wrong, I'm going to tell you a lot more about this, but one reason that's incoherent is that a firm the size of Lehman Brothers, which was 7 times larger than the next largest bankruptcy in U.S. history, that's how big this firm was, a firm like that can't go bankrupt over a weekend unless they have a lot of short-term debt that's not going to be renewed. Right? The way you go bankrupt is you run out of money. And if you have 80% overnight repo financing, you can easily run out of money. But people running Lehman weren't stupid. They didn't set out to have 80% overnight repo financing. That's not what happened. What happened was the market wouldn't lend to them for longer than overnight. So what I want to convince you of is that the crisis is a much more interesting, much more complicated process than this view, certainly of the narrative that's popularly held, but also this two-shock view. So we're going to probe into this crisis, and we're going to try to understand the events and the buildup of systemic risk. So think people throw terms around like tail risk and catastrophic risk. This is a social construct in economy, and it's going to turn out that those kinds of risks are endogenous. Right? They don't just happen. It's not just an earthquake-like thing in subprime, which wasn't big enough. It's going to be the creation over time of a very large risk. And Lehman Brothers was the tipping point of that risk. And I'm going to try to convince you that if it hadn't been Lehman Brothers, it would have been something else. So we're going to ask, why did the failure of Lehman Brothers make the crisis dramatically worse? And in this paper, we're going to argue that during the crisis itself, that participants are trying to preserve the moneyness, if you will, of money market instruments. And they're going to do that in various ways, but most importantly, they're going to do it by shortening the maturity of these instruments. So money market instruments are already short maturity, and what's going to happen over time is that the maturity is going to get shorter and shorter. So we're going to, in this paper, we're going to document this process of the crisis by establishing a chronology of the crisis. So we're going to use an econometric technique that's fairly new, and I'll explain it briefly in a few minutes, but we're going to use this technique to date events of the crisis. And so we're going to see in this chronology various events that are happening starting in January 2007 up until Lehman, and then we'll follow what happens after Lehman. So in particular, there's going to be a lot of things that happen during the period before Lehman when nobody thought anything was happening. And if you read the minutes of the Federal Reserve that were just released for 2008, because 5 years later, you can read those minutes and they had no idea that any of this was going on. Okay? So the money market instruments that we're interested in, there's going to be secured money market instruments, sale and repurchase agreements. So we're going to have general collateral repo, that's repo backed by treasuries. And then we're going to have 10 to 12 categories of repo that are backed by various kinds of structured products, various kinds of asset-backed securities, mortgage-backed securities, collateralized loan obligations, and so on. So this kind of money, repo, functions because it's made safe because you get collateral which you take possession of. Your clearing bank takes possession of it. Then there's unsecured money market instruments, commercial paper. There's not a lot of that that's non-financial. There's, more importantly, is asset-backed commercial paper, and there's Fed funds, and there's euro dollars in the LIBOR market. So in these markets, although the borrowers don't offer collateral, the market works by screening issuers. So in particular, commercial paper issuers are screened by rating agencies, and they have backup lines at banks, and if their ratings drop or they're perceived to be riskier, their paper doesn't roll and they draw on their bank line. The other screening is done by regulatory authorities. Fed funds is U.S. commercial banks, so they're examined. And most of the banks in the LIBOR market are overseen by some national regulator. So when these very short-term money-like instruments become sensitive to concerns about how they're backed, the way to recreate the moneyness of them so that you don't have any doubts that you're going to get your money back is to have tighter screening and higher haircuts and better collateral and shorter maturities. So what's going to happen as the process of the crisis goes on is that all these things are going to happen to try to retain the moneyness of this. But that's going to have a big implication as we'll discuss. So in the paper there's a model. I'm not going to go through the model, but I'm just going to quickly talk about what's going on in the model. So we're going to imagine there's two states of the world. There's the normal state and there's what we call the anxious state. So you can imagine a Markov process in the background, two-state Markov process. And we're going to imagine an economy that enters the anxious state. Now, what does the anxious state mean? It means that you're concerned that something's going on in subprime, and we'll see this in the chronology, right? If things don't get better, you'll enter another anxious state, and in this state, notice what can happen. You might return to normalcy, or you might go on for things to get worse. So imagine that fundamentals are deteriorating as you go along this ray. Now, what we're interested in is how market participants respond at this date. And what we're going to focus on, and what we show in the model, is that at this date, the banks don't want to risk a bad event here, which is going to happen if all the money market participants decide to withdraw, to not renew their loans. So at this date, the lenders would like to have the option to get out at this date. So the lenders only want to lend for one period overnight. The banks would like to borrow long. They would like to avoid having to pay anybody at this date and would like to get to this point in the hopes that if you can avoid this, you get to normalcy again. So what's going to happen is at this date is we're going to see that the lenders want to lend short, the borrowers want to lend long. And that's going to have the implication that the term structure of spreads is going to tilt. So we're always going to think about spread. So if you think about the repo market, we're going to look at overnight repo rates, annualized spread to a benchmark, which will be Fed funds for us. And then we're going to compare that to, say, 1 week, 1 month repo rates annualized compared to Fed funds. So the banks are going to offer a higher rate if you lend for 2 periods and a low rate if you are only willing to lend for 1 period. So the term structure is going to start to tilt that reflects this concern that lenders would like to have an exit option at this date. So at this date, if all these lenders, or a sufficient number of them, are in a position to not roll their loans, to not renew their loans, then there'll be a bank run at this date. So this would be the case of Lehman Brothers. But for Lehman Brothers to be in that position, it's got to be that at this date, lenders have a sufficiently large quantity of overnight loans that they can exit at this date. And why do they want to exit at this date? Well, there was a chance we return to normalcy, maybe a function of policy, but if we don't, they're going to exit here. So this is endogenous. This run is endogenous. It's endogenous for 2 reasons. One, it was caused by the fact that the lenders at this date wanted to build up short-term debt. So they shortened the maturity of their debt. And so we don't even get to this date. We don't even know this. We don't know. This was the Great Depression. We never observed this. We never get to normalcy. What happens is there's a run here. So this run is it's not due to the fact that we entered the anxious state here, the subprime news about subprime here, and I'll show you the date of that. It's because at this date, prior to Lehman, maturities are shortening. And this is true of Bear Stearns too. So Bear Stearns, at the time they were purchased by Morgan Stanley, were also about 80% overnight repo financed. And I asked Alan Schwartz, what's wrong with you? Why did you do that? And the answer was, we didn't have a choice. We didn't have a choice. The market would only lend to us overnight. So the market's creating this possibility of exiting at this state. Okay? So that's the process of a crisis creating systemic risk. Creating systemic risk. So you can imagine if there had been a policy here, even an announcement, an explanation of things which could have changed expectations, then this building up of short-term risk might not have happened. If you as a policymaker could have convinced people that there was a reasonable chance we're going to get to the normal state, particularly because we've adopted a certain policy, then the creation of this exit option might not have happened at this date. But in order to even be able to do that, you had to know that this process of building up short maturity was happening. Okay. So that's what we're going to focus on. So here's, again, a quick summary of the model. Anxious banks want to borrow long, but anxious lenders want to lend short. So the lenders want this option to exit on the one hand, and borrowers want to lock in loans for a longer period of time to prevent the possibility of this exit. And so maturities are going to shorten, and that's going to be reflected in the tilt of the term structure of spreads. And I'll show you what I mean by that more specifically in a few minutes. So the way I think of this is you can imagine if you think about a forest that's in a drought and it's getting drier and drier and drier. Right? So you had a little brush fire, the subprime shock, and everybody thinks it's over. And meanwhile, the forest is getting drier and drier and drier. And it's so dry that at some point, a flick of a cigarette ash is going to cause a forest fire. So it's not that forest fire didn't just come out of thin air. It came because the forest got drier and drier and drier. And that's in this context is the building up of this very, very short maturity exposure because lenders don't want to lend long. So the way we're going to look at this is by testing this chronology, and that's going to lead us to this kind of bank run. There's going to be a bank run because of this buildup. This is the panic of 1907. This is exactly what happened during the financial crisis. There was a bank run. Unfortunately, it wasn't observed like this bank run. If you weren't on a trading floor, you didn't see the bank run. So you didn't see prices plummet, and you didn't see money not roll over. All you saw was big firms get into trouble, and you couldn't understand that. And so, you being some larger entity out there would think, oh, it must be these incompetent bankers. They must have done something sleazy, which for some reason they didn't do for the previous 75 years, but now they did. So this bank run is going to correspond to this buildup of the short maturities, which is going to put these firms at risk of the lender saying, you know what, we're not lending anymore. You better do something because Monday we all want our money. And that's what happened serially, right? The banking system started to unravel serially. First it was Bear, then it was Lehman, then it was going to be Morgan Stanley, then it was Wachovia. So the whole system was going after the weakest, right? And so the Fed was and the Treasury was in this position of realizing there was this sequence where the market was picking off the weakest ones because they had no systemic approach to the policy until they started putting in all these lending programs. So let me quickly just define the spread. So R is the annualized spread at time t for money market instrument I with maturity tau, and then the spread is going to be that annualized rate of return minus the Fed funds target rate at the same time and the same maturity, also annualized. So we can replace the Fed funds target rate with the overnight index swap if you like. It doesn't really make any difference. It's a benchmark rate. Okay, so this is what these spreads looked like before the crisis. Here's a bunch of spreads, and there's all sorts of things on here. Here's general collateral repo. It's below the benchmark. There's also a couple others that are below the benchmark. They're better than Fed funds. And then there's some that are really bad. This is unpriced ABS, MBS, and all subprime. So what this says is the spread before the crisis, the spread above Fed funds of unpriced means that in the repo market, the collateral you're offered, you can't find the price on a screen, right? So in the repo market, when you're offered collateral, the lender looks on some screen to verify the price, but if there's no price, they might accept the collateral anyway. But the spread would be higher, right? The spread would be higher. And there's this one which is lower rated stuff. So money, you would think money market instruments are all money-like in the sense that they have very low spreads, and there's arbitrage relationships between these money market instruments, but they're not all perfect substitutes. They're not all perfect substitutes, and you can see that because some of these spreads are, a lot higher than others, right? So there's sort of different degrees of moneyness. Even in normal times. Now, here's what happens during the crisis. During the crisis, some of these spreads really blow up. Like the unpriced stuff really blows up. A lot of it really blows up, but not all of it. Of course, there's a flight to quality, so general collateral repo spreads go way down. And so that there's this heterogeneity that's introduced across these money market instruments. Right? So there's this kind of common view that, in a crisis, all the correlations go to 1. Maybe that's true in stock markets, I have no idea. But in money markets, that's not true. In money markets in a crisis, there's a distinction between different degrees of moneyness. And that's what you see here. So this is just a time series plot of that same data. And the only point to make here is that I've indicated 2 of the breaks in the series that we tested for. And you can see visually, these are money market spreads. You can see more or less visually the 2 big regime switches here. So that's a kind of visual representation. Okay, so what are we going to do with econometrics? So Jushan Bai, he's an econometrician at Columbia Economics Department, has a paper where he considers how to determine breakpoints using panels of data. Right? So normally you think of you remember from graduate school about a chow test. A chow test means you have to know where the breakpoint is, and then you test it. But there's also ways of looking for random breakpoints in a series. But a financial crisis is not about a series. It's about panels of data, the whole money market, the whole real economy, the whole financial sector. So we're going to be interested in looking for breakpoints in panels, and I'll show you what the panels are in a few minutes. Of course, there's another reason for this. If your breakpoint comes too far at the end of your data set, then standard methods, you don't have enough power to find breakpoints. But when you use a panel, so to speak, you're borrowing power from the panel. You don't need so much on the right-hand side of the time series. So we're going to. I'm not going to bore you with the details of this, but we're going to use this procedure, and it looks for breakpoints in both the mean and the variance. And in the paper, Professor Bai doesn't explain how to calculate confidence intervals when you have possibly changes in the variance also, but he was very kind, and I talked to him on the phone, and he said, "Give me a week," and a week later I got 20 pages of notes. He was great. So thanks to him, we can do this. Now he also shows that in Monte Carlo experiments in his paper that even if your panel's very small, even one series, this technique looks like the standard, some of the standard one single series techniques, but you can have a very small panel. You don't need to have 1,000 series or so. Now, so once the breakpoint is found, you find a breakpoint, say in the middle, you can then search for on two sides to find the minimum of his likelihood function to find the next breakpoint. So you can search for a sequence of breakpoints. Now, this econometric procedure has no, when we find a breakpoint, it says nothing about whether the change that caused there to be a breakpoint at that date was sudden or gradual. Like, there's no power against gradual or sudden. So there are working papers that look for breakpoints that happen gradually, but they're not yet to the point of looking at this with panels. But the power to test between sudden and gradual change, we just don't have. So we have nothing to say about that. We're going to find a breakpoint. We have nothing to say about whether it was gradual or sudden. Okay, so the panels. So the panels, so we divided these panels up a priori into 5 groups. These are all going to be daily prices, and I'll show you what they are in a minute. So there's going to be a panel that's the real sector. There's going to be a panel that has to do with subprime. There's going to be a panel that has to do with financial firms, the old investment banks, dealer banks. There's a panel for unsecured money market instruments and a panel for secured money market instruments. And then in the paper, we exclude Lehman or not exclude Lehman, and there's various ways of tinkering with these panels, which I'm not going to go into. Okay, so the real sector is the VIX, the S&P 500, the JP Morgan High Yield Index, the Dow Jones Index of credit derivatives for investment grade firms. Subprime is various tranches of the ABX index, subprime prices. Financial firms are based on financial firms CDS. And then we have the interbank unsecured market. So we have Fed funds, LIBOR, OIS, commercial paper, A2, P2 non-financial, AA asset-backed, AA financial, AA non-financial. And then we have all these categories of repo. Okay, so each of these things in bold is a panel. Okay. So we're going to look for the breakpoints in these various panels. Now, so this shows us breakpoint, the first set of breakpoints, looking at those panels. Right? So we're just looking at spreads. So already we have a lot of interesting things to say about the chronology. First of all, the breakpoint here is January 4th, 2007. The 99% confidence intervals here are expressed in terms of dates. So the two dates, so with 99% chance, this is between these two dates. Okay? The next breakpoint is in the subprime market. So there's 5 series. I'm sorry, we already did that one. That's the start of the crisis. Repo happens in July 23rd, 2007. So the next break is in repo. And not surprisingly, these firms were about 50% on average repo financed, right? It's not, they're a bank, right? So, a commercial bank, would be 75% demand deposit finance. This is a bank. Its demand deposit-like contract is repo. So if there's a problem in the repo market, you would expect there'd be a problem for these firms, and indeed there is. On the exact same date, you have a break in the repo market spreads. This is break in the repo market spreads. That's big trouble for these financial firms, and so their CDS premia go up. So it's not surprising that these two happen on the same date. What about the unsecured markets? Unsecured markets happen August 8th, and that is different. That's significantly later than this because this date doesn't fall in here, and this date doesn't overlap with this. So this is significantly later. And then in terms of the real sector, it's January of 2008. Okay. So this is sort of the start of the crisis, right? The start of the crisis. So we get the shock. There's a number of downgrades and failures of subprime underwriter firms. The repo market gets antsy. That causes risk in these financial firms to rise. Then it happens in the unsecured markets, and then all sorts of things happen in late 2007 with money market mutual funds and so on. And then we get the first set of real effects. Now, so that's looking at those panels for the first breakpoint. So then I said we can look at more breakpoints. So we split a panel series at some date, and now we can look for a second breakpoint. In principle, the second breakpoint could happen before the first breakpoint. Turns out that doesn't really happen in our data. It happens subsequently. And we can go on and investigate various breakpoints. Now, the buy procedure, he's working on it, but he doesn't have any way to stop. How many breakpoints do you look for? It starts to deteriorate, the confidence interval starts to get bigger, but we calculated 3 and then we stopped for no reason other than we thought we shouldn't go further. Okay, so this is what we get if we just look at spreads. So there's going to be, remember, we haven't looked at the term structure of spreads, we haven't looked at haircuts, all we've looked at is spreads. So in terms of the spread chronology, let's just start with Lehman. So here's where Lehman fails. And here's the breakpoints I was talking about a moment ago, right? Now, these are just money markets. So from this point until this point, the common view is that nothing's happening. Right? So we haven't looked at the term structure, we haven't looked at haircuts. But you can already see that there's a second break in repo here. There's second breaks in GC repo, asset-backed commercial paper, and unsecured. And all of this happens before Lehman, right? Before Lehman. This one is like 3 days before Lehman. So let me just remind you what this says. It says there's something significant that's happening in these markets that we're detecting with this breakpoint technology that's all happening before Lehman. And this is happening during this period when supposedly nothing is happening, right? So that's the first clue that there's more to this story than there's just some big second shock. So let's look at the maturity issue. So I said earlier that the model would predict that lenders want to lend only short, regardless of the rate, and borrowers want to borrow long, and they're willing to pay more. And so when we look at this spread, here's the spread we were looking at before. Whoops. Right there. Now we're going to look at the difference in these things. So this is the term structure of spreads, right? So this says that a maturity of 2 periods it's 2-period maturity and a 1-period maturity. So this is the slope of the term structure of spreads, okay, the slope. So this slope would be flat in normal times, right? So the maturities are endogenous. You have short maturities. Given short maturities and given the screening or the collateral, you don't care. The spreads are all the same. And in fact, that is what we find prior to the crisis, that the term structures are all flat, but they don't go out past 3 months typically. So in one case, there's actual issuance data. And the issue with maturity, and that data is for asset-backed commercial paper. So this is the short-long ratio of maturities for asset-backed commercial paper. Now, this is the only case where there's volume data, but the problem is that a lot of issuers are forced out of the market. So some issuers of asset-backed commercial paper and commercial paper are forced out because their ratings dropped. So even with that positive selection, the maturity still goes up. This is Lehman. This is Lehman. And in fact, if you plot that against this measure of interbank risk, right? This red line is LIBOR, the LIBOR minus overnight index swap rate, a measure of interbank risk. You can see that it tracks very closely. That as the banking system becomes riskier, the maturity is shortening. Now, this is the only case where we have actual volume data. So what we're going to look at is this term structure of spreads. I'm just going to show you some pictures. So here's LIBOR. Here's LIBOR. So there's three lines here corresponding to breakpoints in the data, and this is and this axis is basis points, right? So this is overnight, 1 month, 3 month, and you can see that in normal times it's flat, and then as the crisis goes on, it starts to steepen. It starts to steepen, right? And it's steepening because banks are offering more if you lend long and less if you lend short. And that's true of all these markets. So here's repo that's backed by AA asset-backed securities, whether they're mortgage-backed or non-mortgage or commercial mortgage-backed. Again, you see the term structure increasing. So now let's look at haircuts. So haircuts in repo market, the first time there's a significant increase in haircuts is in October 23rd, 2007. So first the spreads go up, and then what happens is that's not enough compensation for risk because we're not even pricing risk. Money markets are not about pricing risk. We have to have over-collateralization to convince us that we should invest in this. And so haircuts go up. The next time they go up is in February 6th, 2008. And then again, they go up September 15th, which is exactly coincident with Lehman. So the day Lehman fails, haircuts throughout the market rise again. Okay, so remember, a haircut going up is a withdrawal from the banking system, right? So if I lend you $100 today and you give me a bond worth $100, the easiest way to think of it is I lend you $100, you go buy a bond worth $100 and you give it to me as collateral, and the next day I say, you know what, I'm going to keep the bond, it's worth $100, but I want you to give me $10 back. So I'm going to lend you $90, but I'm going to keep the $100 bond, so there's a 10% haircut. Now you have to come up with $10 to finance that. The bond was completely financed by me yesterday, $100, I got a $100 bond. Now I lend you $90, but I want to keep a $100 bond. So you have to come up with $10. Right? So that's a withdrawal from the bank. And so this is the sequence of increases in withdrawals from the bank. Okay, so these withdrawals are exactly the runs that we're interested in. So here's a picture of this where we plot an equally weighted index of haircuts on 10 categories of repo. Okay, so you can see three lines here. There's 3 breaks, and there's this red dotted line, which is subprime related collateral, and then there's non-subprime related collateral, which is down here, and then there's the average. So the market's distinguishing between subprime related collateral, which goes to 100%, and non-subprime related collateral. And if it's corporate bonds, corporate bond had 0 haircuts out to about here, and then they went up a little bit. So this is a picture of the runs, right? So again, let me give you a back of the envelope calculation. We don't have data exactly on how big the repo market is, and there's a lot of controversy about that. Early in the crisis, I came up with a number of 10 trillion, and everybody laughed at me. Then the Bank for International Settlement economists did a different back of the envelope calculation. They came up with 10 trillion, and the IMF economists came up with one. They came up with 10 trillion. So we're not exactly sure, but it's a pretty big number. So if it's 10 trillion and haircuts go to 30%, say, that's a withdrawal of $3 trillion. So what happened? Well, it was a very painful, long process. Asset prices plummeted, and in the end of the day, the Fed bought $2 trillion, and commercial banks, the insured institutions, bought $1 trillion. So that was the process by which this run happened. So let me just summarize all this now with a complete chronology, including not just the spreads, but including the haircuts and the change in the term structure. So the first part is from the start of the crisis through December. So this is what I showed you earlier. It's just detailed here. And then we've included some of the big events. This was the term auction facility the Fed introduced in December 2007. And then there's the real effects. So this is the view. If this was all that happened, it would have been a mild recession. We wouldn't have had to worry. And then there's this part where supposedly nothing is happening, right? Nothing's happening. And in fact, we find all sorts of things happening. And all these things that are happening are this buildup of maturity, because in particular, the term structure is starting to steepen, right? So this is the period where there's this creation of an exit option and the endogenous creation of this massive amount of fragility in the system. And then finally, this buildup ends with Lehman. And then TARP is passed. Finally, Congress says, oh my God, you're right, it really is a problem, and they pass TARP. So it turns out that a crisis is a lot more complicated than you might think. It's not just the arrival of some piece of bad news and there's a big problem. It's not even that the bad news has to be that bad. It has to be bad news that has possible significant implications, where if market participants get worried, they build out this exit option during this period when, if you're not in these markets, you would never have observed it. And that's the process of the forest getting drier and drier and drier, and ultimately culminating in Lehman. So it doesn't even matter what you think the information implications of Lehman failing were, right? Some people argue that, well, it showed that the Fed was going to let banks fail. That's irrelevant. The point is that market participants had to be in a position to pull the plug on Lehman. And the only way they could be in a position to do that is if there was a sufficient amount of short-term debt. And we know from the examiner's report in bankruptcy that it was about 80%, but it wasn't 80% 6 months earlier. So the crisis and this systemic risk and the so-called tail risk is part of this more interesting process to a crisis. And it also tells you that if you are so removed from markets, right? Remember, the Fed they don't trade, right? They're not in markets. If you want information in these markets, you have to be in the market. So if you're not in the markets, you would have no chance of ever understanding that during that period when you thought nothing was happening, in fact, all this risk was building up, which then leads to this kind of superficial view that there was this second thing called a shock. Right? So this whole idea that crises are shocks is kind of a way of saying, I don't know what I'm talking about. Right? Remember that the idea of a shock came from rational expectations. If my expectations aren't met, then I'm surprised. And then later that gets built into real business cycle theory, and we couldn't ever figure out what the shocks really were. But now we invoke this idea of a shock. It's like noise traders. It's things that's shorthand for we don't know what we're talking about. So what this evidence suggests is that there is no large shock. What there is a transition, a dynamic buildup of something, what I've described as the forest getting drier, which then can lead to this very large event. So that's the summary. A financial crisis is not a shock. There's this buildup credit boom before the crisis, which I've talked about in a paper with my colleague Guillermo Ordonez, and then there's this buildup of fragility during the crisis. So these shocks and this tail risk are part of this endogenous process. And let me stop there. Thank you. So I'm not, should I answer some questions? I guess, does anybody have a question? I've stunned you. I apologize. Gunther Strobel must have a question.
Thank you very much for the presentation. I think it was very, very nice. I wonder, what are you actually suggesting now? Should we put some constraints on repo markets? Should we advocate for liquidity coverage ratios for banks? What should we do then?
Well, I have a paper with Andrew Metrick called "Regulating the Shadow Banking System," where we propose some reform. And I will just very quickly summarize it. Basically, what we say is that the government should oversee the private production of collateral. So the problem in the crisis was that market participants began to suspect that asset-backed securities, mortgage-backed, whatever they were not quite what they thought. And the securitization market is not under any kind of regulatory umbrella at all. And yet it's a huge market. Before the crisis, by issuance, non-mortgage asset-backed securities exceeded the issuance of U.S. corporate debt. That's how big and important this market is. So it seems, like a bad idea to have such a big, important market that's not under the regulatory umbrella. So the first thing, you can look at the details in the paper, but the first thing is that we want that to be under the regulatory umbrella. The second thing is we don't want anybody to go be able to do as much repo as they want. So we'd like to confine repo to institutions called banks, and non-banks can do repo, but there's some limits on how much they have to do. Now, the liquidity coverage ratio is kind of this misguided idea about what liquidity is and what a crisis is. Banks, by definition, produce debt. A bank is an institution that exists to produce debt. The output of a bank is debt. Output of a car company is cars. Output from McKinsey is advice. Outcome from Yale, hopefully, is intelligent students. Outcome of a bank is debt. So banks are going to produce debt. Now, if you have a whole institution whose job it is to produce debt, and bank debt is vulnerable to a bank run, there's no amount of liquidity you can have to prevent this. It's never how we prevented bank runs ever before. We have histories of successful banking systems that went for long periods of time without systemic problems. In none of those banking systems was the sole idea that you would have reserves or that you would have capital. Many things had to come together about constraining activities, examining banks, overseeing banks, all sorts of things. And in a world where there's a shortage of safe debt, right? So we have government debt. If there's not enough government debt, the private sector makes debt, right? And that's the problem. If China buys all the treasuries, then we have to make debt, the private sector, but the private sector's debt isn't as good. Now, the liquidity coverage ratio, if that takes out $2 trillion of treasuries and makes them sit in banks in the name of financial stability, that's completely counterproductive. Because you want a system where collateral can move around in a state contingent way to where it's needed. You don't want to force it out of the system. So I think it's unfortunate. I don't understand the BIS. I don't know what planet they're on. I mean, I don't think of the world the way I think of it, and I think it's almost all of what they do is just counterproductive. Sorry. They're nuts. Thank you.